In March 2023, something happened that should have stopped the world. China and Saudi Arabia completed their first oil trade in yuan instead of dollars. Not a test, not a pilot program, an actual transaction. 50 years of the petrodollar system broken in a single deal. In 2024, China sold over $150 billion in U.S. Treasury bonds. The largest holder of American debt was dumping it faster than at any point in history. In 2025, BRICS nations, now expanded to 10 members representing 36% of global GDP, announced plans for a gold-backed payment system to bypass the dollar entirely. This isn't portfolio diversification. This isn't hedging. This is stage 6 of reserve currency collapse. And if you understand the pattern, you know what comes next. Right now, in 2025, the numbers are screaming. China's treasury holdings have collapsed from a peak of $1.3 trillion in 2013 to approximately $850 billion today, on track to hit $500 billion by 2026. China isn't slowing its exit, it's accelerating. Oil trades tell the same story. Russia and China settle $100 billion in annual trade using yuan and rubles. Saudi Arabia, the bedrock of the petrodollar for 50 years, now accepts yuan for oil sales to China. Iran trades oil for yuan. The UAE is negotiating yuan contracts. Each deal removes dollar necessity. Each deal reduces global dollar demand. Gold purchases confirm the pattern. China's official reserves show 2,068 tons, but that's almost certainly understated. In 2023 alone, China bought over 225 tons. Month after month, the People's Bank of China adds gold. They're not buying for investment returns. They're buying because they know what's coming. BRICS expansion accelerates the timeline. What started as 5 nations, Brazil, Russia, India, China, South Africa, is now 10, with 23 more applying to join. These aren't minor economies. Combined, BRICS nations represent 36% of global GDP and 46% of global population. They're building payment systems, signing bilateral trade agreements, and systematically reducing dollar exposure, all simultaneously. This is the largest coordinated exit from a reserve currency in history, and it's happening right now. Reserve currencies don't collapse from external attack. They collapse from internal exhaustion combined with credible alternatives emerging. China isn't attacking the dollar out of aggression. China is abandoning it because the pattern says when the reserve currency issuer hits stage 5, military overextension, unsustainable debt, and fiscal policy contradictions, smart actors exit before stage 7's sudden collapse. China is exiting, and history proves they're right to run. This pattern has destroyed every global reserve currency in history. 3 times in 6 centuries, the exact same sequence. The Portuguese real, the Dutch guilder, the British pound sterling. Each dominated global trade for decades. Each seemed permanent. Each followed the 8-stage pattern to collapse. And each time, the largest creditor's exit signaled the final stage. 1450 to 1530, the Portuguese real was the world's most valuable currency.
Portugal controlled the spice trade, the oil of the medieval economy. If you wanted pepper, cinnamon, or clothes, you needed reals. Portuguese ships dominated trade routes from Africa to India to the East Indies. The real was accepted everywhere because Portuguese naval power guaranteed the routes, and Portuguese merchants controlled the goods. But Portugal overextended, fighting the Ottoman Empire in the Mediterranean, defending trade routes on 4 continents, maintaining fortified ports from Mozambique to Macau, a nation of 1 million people trying to police the entire Indian Ocean. The military costs were staggering. Half of royal revenue went to defense, and it wasn't enough. Stage 2 followed Stage 1. Portugal's fiscal position collapsed. They borrowed from Italian and German bankers. By 1560, debt service consumed 60% of government revenue. Not military spending, just interest on previous borrowing. The mathematics were terminal. Stage 3 was inevitable. currency debasement. Unable to pay debts with taxes alone, Portugal mixed copper into silver coins. A coin supposed to be pure silver became 50% copper, then 75%. The face value stayed the same, but real value plummeted. By 1600, Portuguese silver coins contained barely any silver. Merchants stopped accepting them at face value. Inflation exploded. Then stage 4, loss of productive capacity. When you have unlimited money from colonial extraction, you stop producing. Portuguese nobility considered work beneath them. Manufacturing declined, agriculture stagnated, everything was imported. French wine, Italian silk, Dutch goods. The gold and silver from Brazil flowed straight back out to pay for imports. Portugal became a conduit. Wealth flowed through, but none stayed. Stage 5 arrived when Spain emerged as the rival power. Spanish silver from Mexican and Bolivian mines flooded global markets. Spain had more silver, better production, and growing naval power. Spanish coins became preferred for international trade. The real was still used in Portuguese colonies, but globally, merchants wanted Spanish silver. Stage 6 was the exit. By 1520, Genoa, Portugal's largest creditor, began refusing to extend more loans. They demanded repayment in gold, not debased reals. Other Italian banking houses followed. The largest creditors were leaving. Within a decade, Portugal couldn't borrow at any rate. Stage 7 was the credibility break. A bad harvest in 1528 caused bread riots in Lisbon. The government couldn't pay soldiers. Tax collection collapsed. The system everyone thought was permanent revealed itself as hollow. Stage 8 was collapse. By 1530, the real was worthless outside Portugal. By 1580, Spain annexed Portugal entirely. The nation that had created the first global reserve currency ceased to exist. The real went from dominant to extinct in 50 years. 1600 to 1795, the Dutch guilder replaced the real as global reserve currency. Amsterdam became the world's financial capital. The Dutch East India Company was the first mega corporation, worth more than $7 trillion in today's money. The guilder was demanded worldwide because Dutch naval power protected trade, and Dutch banks offered the safest deposits. For 180 years, the guilder dominated. But the pattern repeated. Stage 1. Military overextension. 4 Anglo-Dutch wars, draining resources. Conflicts with France. The Dutch Republic, built on trade, trying to maintain a navy and army to defend a global empire. By 1700, defense spending exceeded trade profits. Stage 2. Fiscal breakdown. War debt exploded. The Dutch government borrowed heavily. By 1780, interest payments consumed most revenue, the same trap Portugal fell into. Stage 3. Currency debasement and inflation. Dutch banks printed more guilders backed by less gold. Inflation rose. The currency that had been the world's most stable became volatile. Stage 4. Loss of productive capacity. Dutch merchants became financiers. Why make things when you can live off accumulated capital? Manufacturing moved elsewhere. Dutch investments shifted from productive enterprise to lending to other nations. Passive income, not productive growth. Stage 5. Britain emerged. Larger population, growing industrial base, powerful navy. By 1750, British trade exceeded Dutch trade. London competed with Amsterdam as financial center. The pound gained credibility while the guilder lost it. Stage 6. Exit began. By 1770, British investors and merchants reduced guilder holdings. They shifted to pound-denominated assets. Britain, the rising power and soon to be the largest creditor, was leaving. Stage 7. The Fourth Anglo-Dutch War, 1780 to 1784, was the credibility break. British blockades destroyed Dutch trade. Amsterdam's economy collapsed. The guilder crashed. Dutch merchants themselves began using London banks because Amsterdam was no longer safe. Stage 8. Collapse.
Napoleon's occupation from 1800 to 1813 finished what Britain started. By 1815, the guilder was a regional currency. Amsterdam remained wealthy but irrelevant. The reserve currency died while the country survived. The guilder fell from global reserve to irrelevance in 30 years. 1815 to 1945. After Napoleon's defeat, the British pound sterling became the unquestioned global reserve currency. The British Empire covered 1/4 of the Earth's surface. The Royal Navy was larger than the next 5 navies combined. Every major trade contract was denominated in pounds. London was the center of global finance. For 130 years, the pound ruled. But the pattern repeated again. Stage 1. World War I. Britain fought a total war that cost over $40 billion in today's money. They borrowed massively, mostly from the United States. By 1918, Britain was deeply in debt to America. The creditor had become the debtor. Stage 2. Fiscal breakdown. Britain never recovered from WW1 debt. Then, World War II added $120 billion more in costs. By 1945, Britain owed $30 billion, more than their entire GDP. The empire was bankrupt. Stage 3. Currency debasement and inflation. Both wars forced Britain off the gold standard temporarily. They printed money to finance military operations. The pound was devalued in 1949, losing 30% of value overnight. The global reserve currency admitted it couldn't keep its promises. Stage 4. Loss of empire and productive capacity. In 1947, Britain gave up India, the crown jewel, the source of wealth for 2 centuries. Over the next 20 years, they lost everything. Africa, Middle East, Southeast Asia, the Caribbean. By 1970, the empire existed only in history books. British manufacturing declined while Germany and America industrialized faster. Stage 5. America emerged. After WWII, the U.S. held most of the world's gold, the only major economy undamaged by war, 50% of global GDP, the obvious successor. Stage 6. Exit began. At Bretton Woods in 1944, even before the war ended, the dollar was formalized as the new reserve currency. Other nations would peg to the dollar. The dollar would peg to gold. Britain agreed because they had no choice. The largest creditor, the United States, was leaving the pound system. Stage 7. The Suez Crisis in 1956 was the credibility break. When Britain and France invaded Egypt, the United States threatened to crash the pound if they didn't withdraw. Britain complied immediately. The world saw clearly the pound was subordinate to the dollar. Britain couldn't act without American approval. Stage 8. Collapse. By 1971, even the gold standard collapsed. The pound fell from 60% of global reserves in 1945 to under 20% by 1960. The reserve currency died in 30 years. Britain remained a wealthy nation, but never again a global power. 3 currencies, 3 collapses, 3 identical patterns. Every reserve currency in history has followed the same 8-stage pattern. Understanding it means recognizing where we are now. Stage 1. Military overextension. The reserve currency issuer extends military commitments beyond economic capacity, defending global trade, fighting multiple adversaries, unsustainable defense budgets. Resources drain outward while revenue doesn't grow enough to cover costs. Stage 2. Fiscal breakdown. Deficits explode. Debt becomes unsustainable. Interest payments consume growing percentages of government revenue. New borrowing just services old debt. The mathematics become obviously terminal to anyone calculating compound interest. Stage 3. Currency debasement. Unable to tax or borrow enough, governments print money. Inflation accelerates. Purchasing power erodes. The currency that was once the most stable becomes unreliable. Merchants demand more units for the same goods. Savings evaporate. Stage 4. Loss of productive capacity. When you control the reserve currency, you can print money to buy real goods, so you stop producing. Manufacturing declines. Imports exceed exports permanently. The trade deficit becomes structural. The nation becomes dependent on foreign production. Stage 5. Rival powers emerge. Other nations industrialize, build militaries, create alternative financial systems. They offer credible alternatives to the reserve currency, not to attack it, but to reduce dependence. They build parallel infrastructure. Stage 6. Exit begins. As smart actors start diversifying, selling bonds, signing bilateral trade deals that bypass the reserve currency, stockpiling gold. Each action small but directional. The cumulative effect is massive capital flight disguised as prudent risk management. Stage 7. Credibility break. One major shock, a war, a default, a policy mistake, a financial crisis, triggers recognition that the reserve currency is finished. Mass exit begins. What was gradual becomes sudden. Panic selling. Currency plummets. The system everyone thought was permanent collapses in months. Stage 8. Collapse. Reserve currency status evaporates. Wealth held in that currency is destroyed. The nation remains but loses global influence. The international order realigns around whoever controls the new reserve currency or the new system. The transition is violent and irreversible. The United States dollar is following this pattern exactly, stage by stage, indicator by indicator. Stage 1, check. 750 military bases in 80 countries, $850 billion defense budget, simultaneous commitments in Ukraine, Middle East, Taiwan, fighting or threatening war on 3 continents, militarily unsustainable. Stage 2, check. $36 trillion in debt, 123% of GDP, $1.7 trillion annual deficits during economic expansion, interest payments approaching $1 trillion per year, more spent on interest than on defense. New debt just services old debt. Stage 3, check. Federal Reserve printed $6 trillion since 2020. M2 money supply increased 40%. Inflation peaked at 9%. Real wages declined. Purchasing power destroyed. The most stable currency in the world is now unreliable. Stage 4. Check. Manufacturing gutted. Moved to China, Mexico, Vietnam. $800 billion annual trade deficit. Import dependency for medicines, electronics, steel, rare earths cannot produce what the nation needs domestically. Stage 5. Check. China is the world's second largest economy, largest trading partner for over 120 nations. The BRICS represents 10 nations, 36% of global GDP, 46% of global population. They're building payment systems, signing trade agreements, creating alternatives. The rivals exist, the alternatives are functional. Stage 6. Check. We are here right now. China selling treasuries, $150 billion in 2024 alone. Yuan oil deals with Russia, Saudi Arabia, Iran, UAE. BRICS payment system launching 2025 to 2026. 23 nations applying to join BRICS. Central banks buying record gold. The exit is happening. This is the stage the Portuguese real was in by 1520, the guilder by 1770, the pound by 1945. Stage 7. Imminent. Awaiting the trigger. Taiwan conflict. U.S. fiscal crisis. Major bank failure. Debt ceiling breach. Federal Reserve policy error. One shock that breaks credibility. The pattern says it comes within 18 to 36 months of Stage 6 beginning. We entered Stage 6 in 2023. The window is open. Stage 8, 2026 to 2028. Mass dollar exit. Treasury market collapse. Hyperinflation or deflation. Global realignment. The dollar doesn't disappear, but stops being the reserve currency. American wealth denominated in dollars loses 30 to 50% of international purchasing power. The global order built for 80 years dissolves. China's actions are the definitive signal because China is the largest creditor. They hold over $3 trillion in dollar-denominated assets, treasuries, corporate bonds, dollar reserves. They're the United States' largest trading partner, $750 billion in annual trade. For China to dump dollars means accepting short-term losses to escape long-term catastrophe. History is clear. When the largest creditor exits, Stage 6 accelerates to Stage 7 within 18 to 36 months. We entered Stage 6 in 2023. The window is open. Portugal's largest creditor, Genoa, exited in the 1520s. The real collapsed in the 1530s. 10 years. The Dutch guilder's largest creditor, Britain, exited in the 1770s. The guilder collapsed in 1795. 20 years. Britain's largest creditor, the United States, exited in the 1940s. The pound collapsed from 1945 to 1971. 26 years. The pattern says China's exit signals the dollar's collapse within 2 to 3 years. We're inside that window now. The mechanisms of China's exit are visible and accelerating. Selling treasuries. From $1.3 trillion at the peak in 2013 to $850 billion in 2024. That's $450 billion in sales, projected to hit $500 billion by 2026. Each sale reduces dollar demand and signals to other nations that China is leaving. Yuan internationalization. Oil trades with Russia, $100 billion annually in yuan. Saudi Arabia pilot program launched 2023. Iran, UAE, and others negotiating yuan contracts. The yuan is now the third most used currency for international trade, up from 8th in 2020. Each trade denominated in yuan is one less trade requiring dollars. BRICS payment system, alternative to SWIFT, allows member nations to trade without dollars, reduces dollar necessity structurally. Launch targeted for 2025 to 2026. Once operational, 36% of global GDP can trade without touching dollars. Gold accumulation. Official reserves, 2068 tons, bought 225 tons in 2023 alone. Central banks globally added over 1,000 tons annually from 2022 to 2024. The pattern suggests preparation for a gold-backed yuan or BRICS currency. When that launches, it provides a credible alternative backed by hard assets, while the dollar is backed by nothing but debt. Bilateral trade agreements. Over 30 nations now have yuan swap lines with China. Trade settled in yuan, not dollars. Russia, Brazil, Argentina, Saudi Arabia, UAE, Iran, Pakistan, Thailand. Each agreement is one more country that doesn't need dollars for trade. Each reduces structural dollar demand. The United States cannot stop this. The tools don't work anymore. Military threats won't work. China is a nuclear power. Taiwan conflict would devastate both economies. The U.S. lacks the military superiority to force compliance. Any war accelerates dollar collapse because it would prove the U.S. can't defend the system. Sanctions won't work. The BRICS payment system bypasses SWIFT. China can trade with Russia, Iran, and BRICS members without touching Western financial systems. Sanctions become irrelevant when the sanctioned parties build alternatives. Interest rate hikes won't work. Higher rates increase U.S. debt service costs to over $1 trillion annually. This accelerates the fiscal crisis, makes treasuries less attractive long-term because the debt is obviously unsustainable. Higher rates don't strengthen the dollar. They expose how broken the finances are. The pattern is structural, not tactical. The dollar is the reserve currency because of post-World War II dominance. That dominance is gone. The debt is unsustainable. The alternatives exist. The math doesn't work anymore. China sees it. BRICS sees it. The only people who don't see it are those holding dollars, thinking this time is different.
The Portuguese real collapsed in 50 years, the Dutch guilder in 30 years, the British pound in 30 years. Each time the pattern was identical. Military overextension, fiscal breakdown, currency debasement, loss of productive capacity, rival emergence, then exit, then collapse. Each time the reserve currency issuer believed it was different. Portugal thought they controlled the spice trade permanently. The Dutch thought Amsterdam would always be the financial center. Britain thought the empire would never end. All were certain the pattern didn't apply to them. Each time, the largest creditor's exit signaled the final stage. Genoa leaving Portugal, Britain leaving the Dutch, America leaving Britain, now China leaving America. In March 2023, China and Saudi Arabia traded oil in yuan for the first time in 50 years. That was the signal. In 2024, China sold $150 billion in treasuries. That was confirmation. In 2025, BRICS announced a dollar alternative. That was the countdown starting. The dollar has been the global reserve currency for 80 years. The average lifespan of a reserve currency is 94 years. We are past average. We are in the terminal phase. China knows it. Russia knows it. Saudi Arabia knows it. BRICS knows it. The only people who don't know it are the ones holding dollars, thinking this time is different. History says otherwise. The pattern says otherwise. The math says otherwise. China is exiting. The world is following. And once Stage 7 begins, once the credibility break happens, Stage 8 follows within months, not years. The Portuguese real collapsed in under a decade after creditors left, the guilder in under 20 years, the pound in under 30 years. The speed accelerates with each cycle because information moves faster and capital moves faster. The dollar's collapse will be the fastest in history because we live in a digital age where trillions can move across borders in seconds. You are watching the end of the dollar's reign in real time. The pattern has repeated 3 times. It is repeating now. China's exit is not a geopolitical chess move. It is the mathematical recognition that Stage 6 has arrived and Stage 7 is imminent. The timeline from Stage 6 to Stage 8 is 18 to 36 months. We entered Stage 6 in 2023. We are inside that window right now. The trigger, the shock that breaks credibility and starts Stage 7 could come tomorrow or next year, but the pattern says it's coming. And when it does, the wealth held in dollars will evaporate before most people understand what happened. The reserve currency death pattern has never failed, not once in 600 years, and it's not going to start failing now.